live stream event with me, Andrew Wilkinson, Director of Trading Education, and our Senior Economist, Jose Torres. How are you, Jose?
Hi, Andrew. Doing great. Waiting for these pivotal numbers. How are you doing?
Very good, thank you. It's certainly warmed up in the northeast, which, as we'll probably get into later on in this discussion, is a good thing because of deliveries of heating oil costing an awful lot more. We'll back into that one later on, but otherwise doing very well. Can you tell us a little bit about what we're expecting on today's number, Jose?
Absolutely. We're expecting 2.4% year over year on headline, 2.5% on core. Essentially, the continued progression that we've seen inflation slow down from a 3 handle early last year down to the low 2s. So, that's been a lot of progress, but the risk, of course, given that we have a sharp climb in oil prices, albeit they've tempered, to the extent that oil stays above 70 or 80, that will start to meaningfully raise inflation figures going into the year. And of course, rate cut optimism has been pared back because the central bank won't be able to ease as much if you have oil prices start to climb. And that's dented the performance of the Dow Jones Industrial and the Russell 2000. In the beginning of the year, those two benchmarks, which are cyclically oriented, we had an expectation, we still have an expectation of a reacceleration in growth, albeit that's tempered now, as well as rate cuts. So we have those two things combined. The AI trade was taking a break. Folks were getting into the Dow and Russell, but unfortunately, this climb in oil prices really started to erase the gains for the Russell and the Dow year to date. At the moment, as of yesterday's close, the Dow is down 1% year to date. It was up around 3 or 4 at its peak. And the Russell is only up 2%, but it was up 7 or 8% at its peak. So we're really seeing that this climb in oil prices is disturbing the areas of the market that benefit from strong growth, rate cuts, and low inflation.
Well, really, today's number doesn't really matter. It will be a bit of a, oh gosh, darn it. If we get a good number following last month's good number, the Fed's not going to be able to move because of this subsequent jump in oil prices. How quickly will we see the impact of the war on Iran into the next set of inflation data?
Right away. Right now, here at Interactive Brokers, we have a real-time gauge of inflationary pressures. And right now, of course, only 11 days in March, but if the activity in oil prices for the first 11 days essentially continues for the rest of the month, all else equal, we're looking at a CPI of 2.7% in March. That number will be released next month in April. But a lot of things can change, but it doesn't seem that oil is going to plunge. We have oil now. Let's pull up a chart of oil.
It depends where you start from, Jose. If it starts at 120 a barrel, back down to 79 is quite a plunge.
Yeah, the issue is, that's true. But the issue is that, let me pull up this chart, folks. The year over year comps start to really become troublesome because oil was very low last year. So all of a sudden it's very high, even if it's down a lot from its 119 and change, that 85 is still a big difference, folks. So here I'm going to show you a 1-year chart of crude oil. And thank you for your comment. Someone was very happy to see us here today, Andrew. They said, wow, Interactive Brokers live. Love, bro. So we're very happy that you're here. We love you too, bro. And we look forward to seeing you next time and to bring all your friends as well so you can see what we have here. So here's essentially crude oil. Let me erase some lines. So we're at 85 right now. If you look at back where we were last year, we were at 66. So from 66 to 85, that's still a meaningful year over year change, north of 20%. a year-over-year change. So that's, how are you going to be able to sustain 2% inflation with crude oil costs up over 20% year over year? So that's the risk here. Of course, the Western powers are trying to stabilize things. President Trump is talking about how the war is almost over. We have the G7 nations preparing to release some of their barrels that they have in strategic reserves that they maintain for emergencies, try to bring those barrels on. Also been talk of the U.S. Navy trying to promote peace in the Strait and trying to defend ships that are going through the Strait. 20%, folks, of crude oil is transported through the Strait. A third of crude oil overall is housed in the Middle East. So this is a pivotal situation here. The Iranians, of course, their weapon of choice from an economic standpoint is to raise oil prices, because that would bring Tehran more revenue and it would hurt the economic fundamentals of the rest of the world. But it would also help it would also help Russia, of course, which is an ally of Iran historically. So we got to wait and see what's going to happen with the Strait, what's going to happen with the war. But if you expect some kind of tension to persist in the next few months, then it's probably reasonable to think that oil prices are going to stay above 75, 70. If you think we're going to have peace in the Middle East right away, then there's a case that we should go back to where we started the year at, right? Which was at around 56. So, as you can see here, oil's really been trending up. Here's January 1st, really trending up. And then the total explosion here to the upside on this Monday, March 9th, we got almost to 120. And so, folks,
diminishes the argument, doesn't it? Really, that Trump's argument that the Fed should be bringing rates down. This was kind of one of the pillars of his policy to get oil prices down. He did a good job with the Middle East partners in getting them to increase production. Production's increased in the US, and it was looking good for quite some time before this attack on Iran. So this reversal, and it has a very, very quick impact on the consumer, doesn't it, Jose?
Yes, a very quick impact on the consumer. Immediately is going to raise prices at the pump, has already raised prices at the pump. And that, of course, hurts economic growth, because those dollars could have been spent on other goods and services.
And electricity and heating oil too.
Absolutely, yes. Natural gas is also a dynamic that's been, moving higher. Let's look at natural gas year to date.
That doubled, didn't it?
Sorry?
That's doubled in price, I believe.
Yes.
Yeah. So in terms of you've gone over what we're expecting from today's number. I'm not sure what the market impact will be. It's kind of an irrelevant number. So it's the numbers going forward that are going to have some impact. And I think this is more interesting from a prediction market perspective, Jose. What are you showing us there? The change in the CPI exceed 2.4 in what month?
This is this report coming up in 5 minutes and 29 seconds. But just moving over to March, and you see that you have 90% chance of a number above 2.5 and 31% chance of a number above 3%. So, if you want to hedge an uptick in inflation, this could be the contract. 31 cents would turn into $1 if the CPI is above 3% in March. I don't think it's going to be above 3% though, folks. So from a pure valuation perspective, I would be taking the no here. I think we're going to be at 2.7 or 2.8. And then the no offers you, in forecast contract world, does offer you the leeway of, if it comes in at 3%, you still earn a profit, because it has to exceed 3% for the no's to lose. So 3% is a pretty high bar, folks. Go from 2.4 to 3%. And on a month-over-month basis, annualized, that is quite significant. So I think the no here is the move from a valuation perspective.
It's interesting to see how quickly those contracts have moved to reflect this change in the price of oil. Let's get back to today's report. What else is there? Everyone's talking about the price of oil, the war in Iran. What else is there in today's report that we might that might turn our eyes or turn our
Yeah,
head?
I think that you're going to see. So very interesting because the Fed, of course, cares more about the core gauges, but oil is a key input into the entire economy, services and goods. So, for example, airline fares, that's a huge component of the consumer price index. That is a service, right? But it's directly impacted by crude oil prices because jet fuel costs are a big have a big impact on airline margins. And that's another reason why you want oil prices to come down, because margins have been under some pressure. You're dealing with some tariff uncertainties. You're dealing with issues passing on higher costs to consumers. So if you have higher oil prices now, margins do become a little tricky. And the market, has been reflecting that. As you can see, it's been really a series of lower lows here. If you can tell, kind of maybe like a rounding top here in the S&P 500. So we'll see if the bulls can become energized here. But what do you think of this chart here, Andrew? It's S&P.
Well, on a more macro level, it's kind of expected, isn't it? When you have like an all-out war, that it would be negative for stocks. I think it's been constructive to do some work to the downside. Of course, further downside penetration is probably a function of how long this drags on. And that all gets into policy implications of why we're doing this, what are the goals, how long is it going to last, and I think more than anything, any stock trader is really watching news about the Straits of Hormuz, when that's going to be back under or not under the threat of having a tanker sunk. So like, can Israel, the US, get the straits back open safely, which is probably a function of diminishing air power, drone power, those small speedboat power from Iran. Yeah, I would rather buy this chart than sell it at this point, because I'm one of those people who's I think this is a more optimistic scenario in the short to medium term than it is negative. So yeah, I'm okay buying it here compared to, certainly you'd sell the break if it was to come much lower, but I'm not sure that that's going to happen at this point.
Yeah, I agree. I think that when you look at the fact that we were at these same levels back on October 10th, right? So November, December, January, February, March, 5 months, and we're at the same level. During those 5 months, folks, the economy has grown, corporate earnings have expanded. So valuations here are a lot cheaper, and that's really working for the bulls as a narrative for higher prices moving forward. But of course, there are risks of oil prices, of not getting as many rate cuts, and of course, a lot of other uncertainties related to tariffs and the policy outlook, et cetera. But yeah, I would agree with you, Andrew, there. And we're almost going to get the number in around 27 seconds.
We're getting there. So what's the pre-market shout on this, Jose? What is it? Are we up, down on the S&P today?
Pretty flat, around seven basis points. Pretty flat. No, flat here on the S&P now. 49 seconds to go, folks, and we're going to bring you those numbers ASAP.
And don't forget, folks, you can type questions into, direct them to us on LinkedIn and on X, the Interactive Brokers feed there. Just direct them to us, and we will try our very best to address them as and when they come out. I'm trying to refresh my page, Jose. Here we go. 0.3% for February. Shelter up.
Yes, exactly as expected. 2.4% annualized on headline, 0.3% month over month headline. Core 2.5% year over year, 0.2% month over month. Similar numbers as last month. Core ticked down from 0.3 down to 0.2. Headline ticked up from 0.2 to 0.3, but the annualized figures were the same. We're going to dive deep into this report and see. Shelter up barely. So food up 0.4, food away from home up 0.3 month over month. Energy up across the board, but only 0.6%. Gasoline only up 1.1%. Energy services, which are up 11. Energy services up 0.2%. As that electricity declined 0.7, but heating service increases 3.1%. New vehicles flat. Used cars down 0.4%, apparel up 1.3%. Shelter only up 0.2%. Transportation services down only up 0.2%. Medical care services 0.6%. So we'll go under the hood of this report to see what's going on with airline fares as well as car insurance and this transportation services. The shelter story has been pretty, that's been a huge driver of slower inflation. You have the immigration restriction that's really blocking a lot of what would be immigrants coming in and demanding rental apartments and pushing up those prices, as well as purchasing homes, particularly entry-level homes. You don't have that demand, so that's really subduing the pricing power for landlords and prospective home sellers, as well as home builders in that space. And that's huge because shelter makes up roughly 45% of the entire basket. That's been this, and then of course high interest rates and prices that ran up significantly during the COVID era. That's also blocked a lot of domestic purchasing activity, as well as the lack of foreign purchasing.
So, what do you think the Federal Reserve would say to this report and the at the next FOMC, were it not for the Iran war?
I think they would. This report here would definitely point to cuts, especially since without the Iran war, especially since you have inflation in the low twos and you have risks of the labor market weakening. The Fed does look at the government's jobs report more heavily than the other prints. And of course, we got that big disappointment down around 92,000 for February. But the other data has been quite strong. ADP data, the weekly numbers, those have been terrific. Those are pointing to job growth of around 50,000 or so. The ISM surveys, that's softer data, but manufacturing and services, very buoyant from a hiring perspective. Challenger data was good for the month of February after having some bad performance in January. Unemployment claims, very subdued. So, all in all, to an economist like myself that looks at the buffet of data, and I've been conditioned to look at all the numbers rather than a few select favorites, because after the pandemic, things just got really, numbers started going in different directions. Survey methodology questions started to arise, as well as concerns that the quality could have been weakening. That's essentially geared us up to look at everything in the totality. And the overall picture is that labor conditions are healthy, but because you got that big weakening from BLS jobs alongside a tick up in the unemployment rate, alongside 2.4% inflation, probably all right to start with a 25 basis point cut and then see where you go from there.
Very good. But instead, we've got higher bond yields or higher note yields at the 10-year. They've jumped from, I think, did we get under 4% on the 10-year, Jose?
Oh yeah. I've been pounding the table before the Iran war that you wanted to get long treasuries, folks. You can go back to my articles I've been writing in February and January, and you can see on even the live television interviews with CNBC, Yahoo Finance, I'm on the record telling folks, get long treasuries. There was really no reason, in my view, for the 10-year to be at 430 or 420 with inflation coming down to 2.4%, 2.3%, a deficit that was improving, albeit modestly. And that's really, I think that's what brought us under 4%. But then you had this oil price rise. And then I think it was March 3rd or March 4th, I told folks it's time to trim duration. You want to be careful here because oil is a big driver of interest rates, especially duration, the long end, call it 5 years out, because it's, as we said earlier, Andrew, it has the potential to make inflation much worse. When you look at what happened during the Russia-Ukraine war, folks, we saw the CPI go to 9% or so, and the Fed had to hike 525 basis points. If it weren't the case that the CPI got up to 9.1% in June of 2022, right? Because let's say the Russia-Ukraine conflict didn't happen and we would have maybe settled in at 6.8% or 7%, then maybe the Fed would have only had to hike by 375 or 400 basis points, which that means that the Fed added an extra 150 or 125 basis points of additional restriction due to the impact that oil prices had on inflation. That got us up, folks, to 9.1%. We had a down year in the market that year. We were down roughly 20%. We had the initial GDP numbers, it got revised away, but it did signal a technical recession, 2 consecutive quarters of economic contraction, but that got revised away. And that really was driven heavily by this sharp rise in oil prices. In fact, I think that's why once the Western world, President Trump, the administration, saw that oil prices got above $100, they wanted to message to Wall Street, message folks and let folks know that they were going to introduce additional measures to add oil supply to the market, also trying to add optimism that the war was near its end, because over $100, that's a psychological level that gets folks really worried about inflation. In the UK, Andrew, your homeland, as well as in the EU, the European Central Bank, you started to see folks say, okay, they're going to start hiking soon because of the surge in oil prices, especially that that continent is a huge energy importer. So they're more susceptible to crude oil prices going higher. See, here in the US, we do produce a good amount of oil. So we are less susceptible, less vulnerable to a spike in oil prices, albeit we still are negatively affected. But in Europe, the problem is much, much worse. Also in Asia, areas like Japan, South Korea, etc. Those areas, they're islands as well, and they're heavily, well, South Korea is not, but they need low oil prices, because if they have high oil prices, that really starts to eat away at their expenditures, both at the government level, at the corporate level, and at the individual level.
Are we going to hear from Mr. Sosnick today or not?
Yes, we are, folks. We're going to go to Steve Sosnick real quick for a quick break, but stay where you are and don't leave us.
And don't forget, put your questions in. Direct them to us on the live stream here.
Yes, please.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
And of course, Jose, it's politics season. Those have become quite hot contracts, haven't they now?
Yes, politics have become a hot contract. Let's go real quick to the 2-year yield, which I was going to prepare to make some comments on this. 2-year Treasury yield, you can see it as where the Fed funds is expected to be at over a 2-year period, something like that. Right now it's at 360. So the Fed's funds rate is between the midpoint of 363. So this is essentially telling us that the Fed could be at neutral right now, that there's not much more room for cuts, given where the yield is. Now, the yield was at 336 earlier to begin the month. So, we have this rapid increase in a increasingly hawkish Fed. And of course, that's what really weighed on the Russell.
That kind of tells me, Jose, that like a rate cut is off the table for the foreseeable future. That's what that tells me. Would you agree?
Not necessarily, because it could mean that like you get one rate cut and then you're immediately going to start hiking maybe in a few months or so. So, not to get overly excited about rate cuts.
Right.
We're gonna look at the Fed Watch tool real quick just to inform that question. And then we're excited about elections. So we're going to talk to you a little bit about elections, these new tools we have. So not a cut. You're not getting a cut in March. April is 13%. June is 36%. July is 42%. Sorry, no. June is 35 plus 4, so roughly 39.40. Then here you have essentially July. You might get one. A pause is priced at 46%, so 54% odds of a cut. And then September, you start to really open up the path for cuts. But in December, the highest likelihood of where the Fed funds rate will be, and this is what the 2-year yield is telling us, 37% that we're between 325 and 350. But we're at 350 to 375 right now. That means that really the market is expecting just a little more than one rate cut, but 2 is becoming narrower by the minute. So that's really what this Fed funds curve is telling us at the moment.
Yeah, there's a lack of conviction there, in my opinion. That's what it's saying.
Yes.
And I think that quickly resolves under 2 situations. One, the price of oil comes down, and it's the longevity here of this war on Iran that is critical. You start to see a weakening in the labor market brought on by uncertainty in the US economy, and I think you'll pretty quickly be pricing further rate cuts in. So that's an interesting contract to look at on the events side of it. On the prediction market, Jose, is right now that in keeping with what you just showed us, the odds of a rate cut are pretty subdued. So I would have thought that they would increase over time. So definitely something to look at on the prediction markets. All right, what have we got here? We got a nice map of the United States in different colors: blue, red, gray, and gold.
Yeah, I want to thank our design and programming team for really designing these wonderful maps here. Essentially, each state you pick will give you some details on what's going on. For example, it's the New York governor general election. Kathy Hochul expected to remain in her seat at 84%. Bruce Blakeman has an 8% chance. You look at all candidates here. Delgado is also in the running. You also have Democrat primaries, Republican primaries, and then, of course, Senate, House. And here you can go to general election, Democrat, Republican primaries. You can look at a map view, a list view, and here you can kind of go through each state and look at the candidates and see what the odds are. Same thing with the House of Representatives. And then you can also generalize by state. And then you have all these filters that you can use. Like, for example, if I want to look at Connecticut, which is our home state at Interactive Brokers, that's our headquarters in Greenwich, Connecticut. You see here you have some House races, and then you have the governor race here. Essentially, Democrats, blue state, Connecticut, of course, and Democrats are heavily expected to win in across the House races as well as the governor race. Florida, more of a swing state. You have more mix. You have some Republicans on top, and then for example, here in District 16, you have Jan Schneider. You know, she's the favorite at 33%. Here in District 20, you have Sheila Phyllis McCormick, apologies for the pronunciation, 85%. Also here in my district here, Andrew, Florida, 22, we have Louise Frankel at 85%. Also have Anna Medvedeva. She's she's also in the running as a Republican. And then here in the Florida 23, we have Scott Singer and Jared Moskowitz. It's pretty tight race here. Scott Singer, current mayor of Boca Raton, actually, where I reside. So he's going into the District 23 general election. So that's really some of the things that we can see, gather from these maps and stuff. We get very excited, folks, with the elections when they come up. In fact, you can see here, we have our own elections tab, and last presidential election, 2024, between President Trump and former Vice President Kamala Harris, we saw a lot of interest in forecast contracts. So that has been our bread and butter historically, albeit we know recently the bread and butter have been the daily high temperatures across U.S. cities. So that's really been the driving a lot of the volumes in forecast trading. So we're excited that the election season is back up. And of course, in 2028, we'll be gearing up for the presidential election season.
I've always wondered, Jose, why do people believe that they have an edge on temperature? Why are they so popular? Do you know?
I think part of it is daily. You know, you can do it every day. You can also layer on things that are like not probable. So a lot of times you have a 94% chance, yes or no, and folks think it's 100%. It's just because of a liquidity situation. You know, there's a, you know, it's at 94 or 95, similar to in the options market, right? Sometimes you have like a 3-cent put or a 2-cent call, and someone with a lot of buying power, like, well, you know, this is like, they're pricing this at a 97%, but it's really 100 in my view. So I'm going to take it, you know? So that's really what we're seeing in that market. We're going to navigate over there real quick, folks. Okay, this is Chicago. So above 46 is 99, and above 47 is 2%. Above 48 is 3%. So right here, you know, there's folks that might want to take some positions here. For example, they might think that this 92 is a good value because they think it's maybe a 100% chance it'll be below 47, it'll be 46.50 or so. And, you know, just based on that, folks can take on different positions. So this is a better contract here with cleaner probabilities. But so, and forgive me, folks, I'm not a climate expert, but I am a forecast contract expert. 68 degrees in LA, 80%. So folks might be like, okay, it's definitely going to be above 68. So I might want to buy this at 80. And then 72, folks think there's no way it's going to be above 72. This 88 is probably cheap. Let me take the 88 and make a quick 13 or 14% return on that. So that's some of the activity that we're seeing, folks, you know, layer in different thresholds and participate in that realm. But we have a lot of sophisticated folks that really understand climate, really understand weather, And they're doing a lot of complicated techniques. They're looking at the temperature sources and looking at a lot of different kinds of indicators. So based on my conversations, there is a general sense that there's a lot of sophistication going on here in these temperature contracts.
Let's wrap it up with a quick review of the markets, Jose. What was the impact of today's inflation report on stock futures and yields?
Yeah, so this is 8:30 is here. Yeah, so at 8:30, we were at around 8:29, I should say. We were at around 417 on 10s. Now we're at 419. So definitely a higher move on 10s, and then similar on 2s. You were at 360, and then you got up to 362. So maybe folks were looking for some better numbers under the hood. Airline fares 6.5%. Sorry, 1.4% month over month from January to February. Motor vehicle car insurance did decline 0.3%. So those are some inflationary aspects. Airline fares, folks, up significantly 3 months in a row. Expectation, of course, they're going to be up in March, considering how high jet fuel prices have gone, as well as price for the uncertainty. So also a shelter, that didn't slow down as much. 0.2 is slow, but maybe a 0.1% or a 0 was what Wall Street was looking for, to be more optimistic about slower inflation going forward. So really good report overall, but with, like you said earlier, this report doesn't matter much when you consider the risks ahead. And I think for that reason, we're seeing this move up in yields. Let's look real quick at what's going on in equities. Equities are down modestly, 23 basis points. They were lower at around 5:57 a.m. So, kind of in this trading range here. Just pull up a year to date, doing more work to the downside. Year to date high was around 7,000. This is the S&P 500 E-mini futures. So low on the year. Let's go to the S&P real quick. Sorry, folks. Low so far this year on the S&P was 66.35. High was 7,003. So we'll see if, we're here, got a series of lower highs here, kind of rolling lower. We'll see if the bulls can come back and, not that far away from all-time highs here, folks, roughly 3 to 4%. So let's see if the bulls can come back and get excited. If you have an ending to the Iran war, you have inflation starting to cooperate again, hopefully maybe in April, May, or June. Corporate earnings strengthen. Folks aren't that worried about tariffs. Margins remain okay. And I think we can have a modestly decent year, although the risks are skewed to the downside. Strategist Steve Sosnick has been very adamantly talking about the risks. AI enthusiasm is fading. The Qs have done really poorly this year, much worse than the S&P. The S&P is down 1.4%. Qs are down 2%, so not much worse, but still down. And it's been flat, since October, really. So we'll see what happens. But 600 on the Qs has been a strong point of support going back to late September, folks. We were there September 22nd. So if you like tech stocks, you have 1, 2, 3, 4, 5, 6 months. 6 months tech stocks being flat. Earnings have grown during that time. Economy has grown during that time. So if you like tech stocks, it wouldn't be a terrible time to want to get in here around 600 on the Qs. And that's we have a flat day in the market so far, a little down, but we'll see what happens. Sometimes at 9:30, you have a lot of folks coming in, you have a lot of buying pressure, and you have a big reversal. One thing that's been going on too, Andrew, last few days since and we'll have a down day. We've had down days, of course, but we don't close near the lows. So that's particularly telling in terms of the buying appetites that are out here in the market. And this, the support, you know, you have the Trump put, you have the Fed put to an extent, you have the taxation put, you know, we have fiscal concerns here in the States. And how could revenue survive with a stock market that doesn't keep climbing? You know, so that's a big put as well. So yeah, those are some of the dynamics. VIX still elevated at 25.63. So, you know, could expect to continue seeing some bumpiness year to date. This is on a firm uptrend, folks. Started very low, started the year off around 14, got up to around 35, 36 Monday, March 9th, when we saw oil spike like that, but still at around 25.66. Long-term average is around 20. So normal to expect what looks like a down day in the morning turns into an up day in the afternoon, or vice versa.
What's the next piece of economic data that's going to help drive the markets?
Yeah, I think we got jobs out of the way. We have CPI out of the way. We have PPI coming up. We got consumer confidence coming up. Let's look at the calendar here. This week, we have unemployment claims. That's probably going to be contained. Building permits and housing starts won't have much of an impact. Heading over to Friday, we have durable goods orders. That's not going to be that much of an impact. So this week, JOLTS could be an impact on March 13th. Consumer sentiment could be an impact. So you have, you know, some things to look at. Sentiment, of course, is important. That's probably going to be a bad number. Expected down 50 to 55 from 56.6. This is a March number. I think this is too high at 55. This Michigan sentiment number is highly susceptible to oil prices increasing because consumers hate paying at the pump. When they have to pay $15 more to fill up, they don't like that. JOLTS is pivotal because it's going to talk about the job opening situation and what labor demand is looking like. Expected 6.7, a little bit of an increase from 6.542. That number is particularly significant because it fell down to like a 5-year low or something. You can see here recently. Yeah, you're down to 6.542 is the lowest going back to the pandemic year of 2020, September 2020. So you have some weakening here in job openings and labor demand. Let's look at the Indeed gauge of job postings. This is a more frequently updated gauge. So, you know, weakening, but it doesn't look as bad. It's kind of like a slow weakening. But recently it started to tick up a little bit in February. So, you know, mixed messaging here on job openings from BLS and job postings from Indeed. Job openings from BLS does have a really low participation rate. So a lot of folks, they decline to participate in the job opening survey. So that quality issues in that report has been particularly elevated. So yeah, those are some numbers that we have coming up this week, folks. Just one more time, University of Michigan consumer sentiment, job openings, those two can have an impact. Unemployment claims could have an impact. But outside of those 3 reports, nothing really from an economic data perspective this week that can really move markets that much.
All right, Jose Torres, Senior Economist down in Boca Raton for Interactive Brokers. Thank you very much for walking us through the data today.
My pleasure, and we will see you all soon. We have more stuff coming up this month. Next week on the 18th, live producer price index, that's in Espanol. And then we have also towards the end of the month, consumer confidence. I think that's March 31st. Andrea Brown supporting us in the background. Thank you so much as usual. Thank you to the team at Interactive Brokers. Thank you, ladies and gentlemen. And thank you, Andrew, for being our host here today.